Sushil Choksi, can you just break it for our viewers that what is the total impact for Reliance because of this? Because there is some confusion that... Yes, please.
Good morning. Thanks for having me on the show. But, it is very difficult to estimate as on today based on the tax which is imposed per diesel and rest of the fuels. But one can certainly say that the additional profit which Reliance has made in Q1 or possibly will make for the year because of the Russian crude and domestic parity which was not there. But keep in mind, Reliance was set up as a SEZ refinery. So I don't have a clarification whether there's SEZ norms which are EOU, whether government can apply tax. On a domestic tariff is fine. This is a confusion I have. I'm not saying the market needs to know. Second thing is, Reliance Refinery standalone valuation per share is approximately around 330 rupees as per Bernstein report which came yesterday. And the entire petrochemical was at 700. Worst case scenario, the stock can have an impact of 10% based on the additional tax which has been. The super abnormal profit of $25 may go down to $15, $17. It can't go below that. And 15, 17 also would be a historical high margin number for last 10 years.
Can you just break that again for us, Sushil? I just missed the last part.
See, Reliance is processing approximately 1.3 million tons of crude a day.
Okay.
Annual capacity run rate has been approximately 72 million tons.
Okay.
Second thing is, Reliance's one refinery was set up as EOU, SEZ.
Yes.
I don't have a clarification whether this can happen. Now, it depends on Reliance is exporting how much of diesel, how much of petrol.
Okay.
The market buzz that Reliance was exporting additional diesel right now because the cracks were in favor. But based on the government news, Reliance can always tweak what product gives them a higher margin and which possibly government is not intervened to post tax on. So you'll have to break up product wise and then I calculate. But what the initial reports which are coming, the Morgan Stanleys and the Bernstein, are valuing the Reliance refinery business standalone, not petrochemical, at approximately 330 rupees and petrochemical at 400. So the cumulative value per share was 745. If the profitability is down by 10% based on this, the value can go down by 75, 80 rupees. It's more of a sentiment which is making an impact because Reliance has value mix between various products. So basically they'll have to move their product basket according to what the tax is and what is profitable.
Say the stock reaction today is not a knee-jerk reaction. It is more like a technical factor which has played. I mean, the stock should have not fallen more than 100 rupees. Worst case scenario, it has fallen 150 rupees.
I don't agree, Nikhil, in that way. It is like steel businesses which got impacted. So initial reaction with current market scenario, it would stabilize in a day or two, but possibly correction is based on what is the new outstanding on the new futures. Because currently I see the cash market volume is in the vicinity of only 1 crore shares. And based on 50% is average traded delivery, 55% in the first hour, 55 lakh shares have changed hands for delivery approximately. So by the day you may see 2 crore shares changing. So that pressure is being absorbed by retail or it's absorbed by institution, we don't know. But in the sentiment which was the most positive for the year for Reliance upgrade in terms of value of valuation based on the earnings upgrade which was coming, this is a little dampener. So you'll have to readjust again 3,200 to maybe 2,900, 3,000 or 3,100 on the stock on an annualized basis.
Right, Sushil, really appreciate your time.
But on to the other breaking news right here on ET Now is the big one coming in from the government, which has imposed a duty of sorts, a windfall gain on exports of diesel. But what's more, it's also going to be, now seems, on domestic production. Reliance Industries, let's bring up the intraday chart for you. You can see how it has fallen. ONGC is the other one to watch out for. With the ET Now analysis does show that now it's looking like for production, it's going to be a tax of $40. DK Saraf, the ex-chairman and managing director of ONGC, joining us to help us understand this. Good morning, Mr. Saraf. This is Nayantara Rai. To chase you with a microphone when you were the chairman of ONGC, having the honor to interview you here from the studio. What's your analysis? I know it's just come out recently. on the windfall gain on diesel exports, but now it's looking like it's also going to be for domestic production, translating to $40.
Yeah, the limited knowledge I have on the subject as of now. It seems that the government has levied export duty on some of the petroleum products at different rates. And if I'm correct, then I think it's a very intelligent move from the government side. Because the government would earn some revenue and the government would be able to mop up some of the abnormal profit which the refining companies are making. Here I need to distinguish between the oil marketing companies and refining companies, because oil marketing companies are losing today because they have to sell the products at discount. But the refining companies are making supernormal profit. So while those companies which have both the functions like IOC, BPC, HPC, they are balanced more or less. But the standalone refineries, they are making like MRPL and Chennai Petrochemicals, they are making huge profit. So this decision of the government seems to tax those stand-alone refiners. I think it's a good move without increasing the price in the domestic market. Government would earn significant revenue.
Yes, Mr. Saraf, that point is absolutely taken. But what do you think could be the impact on individual companies here? Of course, you have seen ONGC at close quarters. What would be the impact, do you think, on their margins as well as realizations, etc.? And for other companies like Reliance, would you have a sense of what percentage of their business gets impacted because of this news?
No, Reliance is also a net exporter to the extent I understand it. But I was just looking at that the share price of ONGC as well as Oil India is also down. I don't know why it is down. It could be because Oil India holds a significant percentage in Numaligarh Refinery. They may be exporter, and ONGC because of MRPL. But to my understanding, as of now, there may not be impact on the exploration companies.
That's the word coming in, at least from the initial reading, there won't be an impact on the exploration companies. Mr. Saraf, thank you so much for joining us.
You're watching First Trades, and the big story at this hour has to do with everything to do with oil and gas and the government's move on wanting to tax oil producers for making windfall gains and also to disincentivize them for exporting. The argument has been the state-owned oil marketing companies, IOC, BPCL, HPCL, have been selling petrol, diesel at a loss in the domestic market, whereas you are seeing exports and big bucks being made. So you are seeing an additional tax of $294 a ton that has been imposed, that translates to about $40. You've also seen a hike in duties when it comes for exporting diesel, petrol, ATF, and producers being told that they have to sell at least 30% in India. M.K. Surana, the former big boss of HPCL, now live with us right here on ET Now. Good morning, Mr. Surana. This is Nayantara. If I could first, by taking your initial reaction, windfall tax. We saw it being exposed in the United Kingdom. United States is deliberating it, and here is India now saying, and also maybe trying to disincentivize exports. What do you make of it? What's your analysis?
Yeah, good morning to everybody. The oil prices had been on boil for some time now, and I think it is logical for all the governments to ensure that whatever can be done to ensure that the commodity prices are under check, also to ensure that the inflationary pressures are not actually does not go out of bound. So there is logical for the governments to take action, and in this regard, government is exploring all the avenues. Now, what has happened is there is some distortion which got created because the crude prices are very high, the cracks are very high, cracks are exorbitantly high rather, which is never the case. You never see a crack of $70 or so on diesel or $35 or so on MS. Now it has led to some sort of distortion in the market where it became possible for the people to export at a higher price, and if the domestic prices are not in tandem, then somebody who is setting in the domestic market will be a loser while at the cost of somebody else. So I think this is one of the logical ways for the government to ensure that the domestic market is not at a disadvantage just because the export market is at a very boom. Now, one more thing which has happened that the OMCs, like this, the PSU oil marketing companies, have got the responsibility to ensure that the country's need of the energy are met. And so their first priority will be to ensure that the market is well fed. And so this distortion has affected the PSU oil marketing companies more, while the private people had a choice to take a commercial call. The third thing which had happened is the companies who are purely standalone refineries, they were the beneficiaries because of very high cracks, but the oil and marketing companies, or the companies who had the marketing setup, a part of the refinery gains were actually getting offset, or rather completely offset by the marketing under-recoveries. And therefore, I think that it is logical to have some sort of mechanism in which the people do not take the advantage of the situation to make the money at the cost of the domestic consumers. Now, as far as upstream oil companies are concerned, the same thing holds good, that the crude prices had been very high, and if the domestic prices are not in tandem with the overall market, then there is one other way for the government to see whether that can be considered as a way of generating revenues, and maybe give some relief to the domestic sector.
Okay, Mr. Surana, thank you so much for clearly articulating what does this mean for a lot of companies. But if I can ask you to put the hat of being the veteran in the entire oil and gas sector, which companies do you see will get most impacted? Which are the companies which have the highest exposure when it comes to the likes of export as well? Because the initial understanding that we are getting is that it is possible that this levy is not applicable on SEZs and EOUs, which is a large part where Reliance exports its refined products from. Is that understanding correct?
No, we can see the fine prints, but it may be possible because the export-oriented units are actually made to export only. So we need to see the fine prints, but that is a possibility that the completely export-oriented units may have some comfort from this circular. We have to see. I have not checked the circular, but there is a possibility.
And would you have a sense, I know it is very difficult to say it at the moment, but would you have a sense of what kind of impact could it have on the refining margins or the bottom line of the companies? Because as you pointed out, the oil marketing companies right now are struggling to make profits when it comes to the marketing size of the business, because they haven't been able to increase the retail prices. On the flip side, whatever they were making in terms of refining and exports is now getting curbed. What kind of impact should we expect on the bottom line on a net basis?
So basically, it is difficult to say right now because it will not be a straight line equation to do that. That if you suppose there is an export fee of 13 rupees. So, but what will happen is that some of the refiners were exporting the products to overseas market because the local sale was cheaper. Now, in that case, the market was shifting to the PSU oil marketing companies. So at one end, there were restraints on the margins, and second, there is a substantial increase in the volume because the market was shifting from the people who have got flexibility to export versus to PSU oil companies. Now, once the export becomes less incentivized because of this export duty, then those products will come to local market, and to that extent, the pressure on the oil marketing, PSU oil marketing companies will reduce to cater to the increased demand at a not that advantageous position. The second part is that as far as the upstream windfall tax or whatever you can call it, that is, I assume that it may dent the upstream oil companies. But as far as the refineries are concerned, they will continue to get the crude at the internationally determined price, And so we need to see the two factors differently. The first will be a tax revenue for the government, which they can be used to give some comfort on the other side. The second part will be to reduce or eliminate the distortion in the market, which has got created because of this pricing, where the export was becoming exorbitantly beneficial for the people because of extremely high cracks.
Mr. Surana, thank you so much for joining us here in ET Now to help us understand what it is that is going on. When we